boxes set up. Just wait for that to confirm and then we'll start. Yeah, thanks, Shauna. Beat me to it. Hi, Rolando, Yanko. Yeah, okay, right. Let's just get rid of it. Yeah, okay, that's super. Well, we have seen what we have been seeing a few times recently, which is a kind of a turnaround Tuesday. Often we've been seeing risk-on sentiment flowing into the markets on Mondays. We have historically, in the recent past, low reporting of cases of COVID-19, and often we've seen a turnaround Tuesday where risk sentiment sort of sours for the Tuesday, and we've basically seen exactly that pattern today. So I'm going to start by looking at our dominant currency sentiment pair. Now, our dominant currency sentiment pair for the session is the Australian dollar, US dollar currency pair. Now, overnight, US equity futures started trading a little bit flat and negatively on the feeling that the strong buying pressure we'd seen in the Chinese equity market, in the Hang Seng and the Shanghai Composite, remember it was up over sort of 3, 4, 5% on Monday, that was a little bit overcooked. So there was concerns that the Chinese stock markets had ascended too fast, too quickly, and that was tempering risk sentiment. And what really really turned the risk sentiment this morning was the concern early this morning, was the concern over the rising COVID-19 cases. And we had news out of Victoria State in Australia, which they've increased their lockdown measures now. And starting shortly, there's a 6-week period of lockdown for the city of Melbourne. Now, Victoria State is the second most populous state in Australia. It has over 6 million people in the state. So that has resulted in some concern and selling off of the Australian dollar. Just hang on a minute, I'm just going to move my mobile phone. Sorry about that. So that's been the concern that's been dragging down the Australian dollar. Just taking a look at the increase in cases, you can see here the problem that has been happening in Australia. This is in Victoria State. You can see this sudden spike in local cases, hitting up towards that 200 level, and that, we're seeing sort of similar to what we're seeing in the US. The initial spike and then a secondary spike, which is worse than the first spike. This is a pattern that's been seen in the US. And you can see that same kind of pattern emerging here in the state of Victoria. So obviously the concern is that it's getting out of hand. So back to lockdown measures. That's been weighing on the Australian dollar. We've seen strength in the US dollar on the risk off tones. So an Australian dollar, US dollar downside bias is our dominant currency sentiment theme for the day. Now, I just want to point out to you on the daily chart. Now, this was something that I was looking at this morning. You can see here, we've got this kind of triangle forming here. If you just look here on the daily chart, you can see this triangular price action with 1, 2, 3, 4, 5 touches of the triangle. And you can see that, anyone short from this first touch of this, which is now a descending trend line on the upper side of the pattern, you can see that they might be moving down. And if we get a break of that on any further risk off tones, you'd expect to see a one move extension of the pattern size. So from here to here, if we get a breakdown there, you'd expect from there down to there, probably just down to this overhead support level. Now, the reason I'm not in that trade is for a very good reason, which is we've seen this constant bias towards positivity. So although we've been seeing risk off tones emerging when we have rising COVID-19 cases, we don't see those risk-off tones continuing. They often sort of last for a little bit of time and then they fade away quite quickly. That's been the repeated pattern that we've been seeing over and over again. So that's just something to really, really bear in mind. Really, that's an important aspect to bear in mind. Taking a look at the Dixie, Arno was pointing out in one of his previous videos that we can see that the dollar index has moved up into that a significant region of this 97.10, 97.20 region, which has been significant over recent past. And we've got the ADR high, we've got the R1 resistance point. So that's just worth bearing in mind for anyone short the Australian US dollar, is those two factors, which is one, we've been rejecting this triangular pattern and moving to the downside. Two, we're seeing dollar strength which could possibly temper. Now we've hit that ADR high for the day. So the jury's very much out. And remember, the market's been focusing on positivity and ignoring the negatives. Now, whether it will continue to do so or not, obviously we can't be sure. So let's just take a look at the markets and just see what state we are in at the moment. And what we can see at the moment is that European equity markets are moved lower. We have the US future markets lower. We can see bond markets are generally lower on the day. We also can see copper prices are falling, crude prices falling. We have gold and silver, both of them are a little bit down on the day. So looking at the currency space, we'll just fire that up. Look at the currency space. We're seeing sort of more classical risk-off tones with broad weakness in the commodity currencies. We have been seeing some strength in the Swiss franc, Japanese yen moderating a little bit now at the moment, and we're seeing dollar strength. So it's more towards a classical risk-off move. We're seeing government bonds moving generally lower across the board. So the risk-off tone is still, firmly in the market, but just got to be aware of this dollar index hitting this key overhead resistance level. So that's just the only caveat to be aware of, because the obvious place to join Aussie US dollar downside now would be any return back up to this S1 pivot point. So anything back up to this 6.9 kind of 40 region can be considered suitable for shorting. However, if more conservative traders might want to wait, see if this dollar pullback goes back down to the pivot point 96.80, then that would make this 6.960 region, the pivot point on the Australian US dollar pair, a more attractive level to short from. So shorting from here is getting towards, the moves are quite extended on the day. So my preference would be waiting for a deeper pullback, that 69.63 region, and just watching the dollar index carefully. Obviously, if we see the dollar index moving up above those highs, breaking above that 97.20 region, then that is opening up another leg potentially lower in the Australian dollar, US dollar currency pair. But that's our bias, and that bias remains in play. And for the more active traders, you can look at that 69.40 as a legitimate area to short, but just keep in mind the dollar moves at the moment, particularly in case this dollar move retraces, not forgetting the fact that the market has shown this proclivity, this bias towards positivity. So that's why I would favor a 69.63 entry as a better value entry area. And then, of course, bearing in mind, we have this, this triangular pattern. So if anyone did enter at this 69.60 or still in the trade, remember, there is always the possibility for this downside triangle pattern to break out to the downside, and you'd expect an extension of this whole pattern. So from there to there, you'd expect that to travel from the breakout to there. So another way of potentially trading this pattern would be, say, the risk-off tones continue and we get a break and close below this level, and then traders could either trade the close of the pattern, the break of the close on the daily chart, or they could take a retest of the pattern, the retest of that trend line to the upside. The reason I don't favor that is because of the risk tone being, it's been switching off and then back on, off, back on. We've seen this kind of bias to the upside. But I just wanted to point out that pattern because it is a legitimate technical form of analysis and quite a good way of defining limiting risk, and it's got some clear entry and exit methods with the method, so that can be helpful. So I hope that's sort of a bit of a short-term view and a potential long-term view if we see this risk-off tone carry on, and particularly if we see cases rising in Australia and particularly spreading to more different states. Now, in terms of risk events coming up, just going to look at some of the main risk events. We have a very light calendar for this afternoon. One thing to point out on the calendar is the private oil inventory data. Now that is out due just before the end of the US close. And this private oil inventory data is used by traders to kind of get a heads up for the oil data release, the official crude data release on the following Wednesday at 3:30 UK time. So this private data here kind of give traders a heads up on what stock and inventory levels are like. The API data, this private data here, totals about 80% of all the inventory levels. So it's a pretty good indicator of what's coming on the following day and is used by traders for that purpose. So that's one risk event to be aware of if you're trading oil and if you're trading the Canadian dollar. So to be on the lookout for that. And of course, we'll have our daily risk event outlook for previewing the expected crude stocks on Wednesday. So we'll deal with that tomorrow. But the private data is out tonight. In terms of central bank and political events, there is one interesting event to be aware of. That's coming up tomorrow. We have the British Finance Minister. The name for that in the UK is the Chancellor of the Exchequer, which is basically the Finance Minister, is announcing an update on plans for steering the economy through the coronavirus. So we're essentially seeing a mini budget. And there's all sorts of different kind of rumors of what's going to be released here, including a voucher scheme where individuals within the UK will be given vouchers to spend in struggling sectors of the economy, down to stamp duty being removed for house buyers and various other tax relief schemes, including a potential reduction of VAT. So for the pound, that will be potentially volatile. Now, just remember, unfortunately, this isn't as simple as, great, there's going to be some stimulus in the UK. This is a simple question of buying the pound. Unfortunately, it isn't that simple. We've seen the pound behaving rather strangely. At the last Bank of England meeting, remember, we saw a little bit more of a positive perspective for the pounds. It was back here sort of 18th, 19th of June. And despite that positive kind of outlook, we saw the pound sell off. We then saw positive pound retail sales. The pound sold off. We saw positive PMI data for the pound. The pound sold off. Obviously, Brexit concerns are in the mix, and also concerns that if the UK does expand its fiscal stimulus and does injecting more money into the economy, that is raising the UK's debt level, which is now over 100% for the first time since the 1960s. So it's a mixed picture. So the best thing for this announcement is to be waiting to see how the market reacts to it. It's too difficult to have a clear direction on the pound, and we can see this little bit of range bound action in the pound is kind of showing us that indecision, because it's a little bit difficult to see, particularly in the way that the pound's been acting in the recent past. So just to be aware of that analysis. But if we do see some strength in the pound, it could well be on the anticipation of the Rishi Sunak's mini budget that is scheduled. A couple of other events to be aware of. Don't forget the Eurogroup meeting due on Thursday, but at some point we're expecting the details of the compromised European Recovery Fund proposal. Keep your ear out for that on the wires. Obviously, COVID-19 cases. The other thing to be aware of is we've got earnings seasons coming up. Now, the majority of earnings seasons, like over 50% of them for the second quarter, are due at the end of July, beginning of August. But some of the early front runners will be used by the market to kind of set the mood tone. And remember, the market's in a bit of doubt here again, because a number of companies, when they submitted their first quarter earnings, they didn't submit forecasts for the second quarter because of, obviously, of the coronavirus. So that means that, again, there's a lot of uncertainty over what these second quarter earnings are going to be like. So there's a risk that I can see that these second quarter earnings are very bad, and that they put bad projections for the third quarter. You know, if that's the case, then we could well see some of the stock market gains that we've seen recently selling off. And we have seen a little bit of consolidation in this recent range over the last sort of 4 weeks or so. So this consolidation after this large drop lower would indicate, you know, potentially another drop lower to the downside. And this earnings season that we're about to come into could be the catalyst. Now, obviously, I've been very surprised about how much the stock markets have rallied. That has been on the enormous amounts of stimulus around the world, particularly from the Federal Reserve in the US, and fiscal stimulus from governments. That's just boosted equity markets. And then the NASDAQ has even been making fresh record highs. So you can see, looking at the NASDAQ, that, you know, that's actually making record highs. A lot of the stay-at-home stocks, Netflix, Amazon, are from the tech-led NASDAQ. So in one sense, it's not massively surprising, but in another sense, that's really surprising that the NASDAQ is making fresh highs during this incredible pandemic. And obviously, a lot of analysts are saying that the price to earning ratios are too elevated to be maintained. So there are a lot of sensible voices, and there's a lot of sensible investors who are still heavily in cash, who are not buying into this recovery. So that's just one word of caution. Now, of course, the recovery might keep going on. The unlimited quantitative easing, the huge amounts of stimulus that just keeps growing, might be taken by the market to just say, yeah, this rally can go on, even though it is out of sync with reality, but still the finance is supporting it. So the moves will keep moving higher. Although this earnings seasons we're coming into could be a reality check. So that's just something to be aware of. It's more a contextual point. So we've got that coming up. So that is something to keep in the back of your mind. Now, oh yeah, okay. Of course, Brexit issues as well with the pound. So keep that in mind in terms of headlines. European Recovery Fund. Oh, the last thing I haven't mentioned, sorry, is the US-China tensions. There's a developing narrative of China versus the West, which is particularly concerning. It could result in some quite strong risk-off tones if that develops. So we've obviously had the Hong Kong legislation out of China, and as a result of the Hong Kong legislation, a number of countries, US, Canada, Australia, UK, have reacted to the legislation, and now China is potentially looking at reacting back. There's been a number of countries talking about limiting Huawei's influence in their domestic networks. So there's this beginning of a narrative of China versus the West. Look out for that, because that could potentially turn markets risk off if that becomes a lot of a wider problem and it bubbles over from niggles to more serious implications. Okay, I'm going to go over now to the question and answer session, and just going to, yeah, Shauna, hi, yeah. Hi, Shauna, when you explain the triangle pattern, what do you mean by looking for a break and a close? Is there a specific candle I'm looking for or something more technical? Yeah, let me explain that, Shauna. So, okay, when you get a technical pattern like this, okay, you can see that it's a triangle pattern that's formed. You sort of want a minimum of 4 touches of the triangle pattern. So you've got 1, 2, 3, 4, 5. So you've got 5 touches there. That makes a legitimate pattern. Okay. Now, there's different. Like, I was looking at this morning, thinking, oh, okay, this could be a good place just to short at market with running my stops above the high. Now, the benefit of shorting this was that if this does work as a technical pattern, you'd expect a breakdown to the downside because I'm going to risk off sentiment, and then you expect an extension of that move. So the attraction for me was, well, look, hang on, I can sell here, and you can get a relatively nice large reward for a relatively smaller risk. As I said, what put me off was the fact that the market has this bias towards the upside. So in the end, I didn't jump into this. But if the bias was more, I was expecting more of a prolonged move, then that would have been nearly a perfect setup for me. Now, there's different ways when you have these technical setups. Now, just take our eyes away from this being the Aussie US dollar pair. Just look at it in isolation as a technical pattern. Now, there's different ways of trading these technical patterns. You can enter before the pattern kind of plays out when you're sure of the fundamentals. So in this instance, because I had a deep sense of the fundamentals for this morning, I was not expecting a breakout to the upside. I was expecting that this point would complete the pattern and would be the latest swing high. So it was an obvious swing high to put your stop above. You can limit your risk. You're nice and out of the way. And you're into the pattern, but the pattern hasn't sort of played out yet. But because of the fundamentals, you know that you're more likely to be testing the bottom line and moving to the downside than you are to the upside. Now, other ways of trading this are, you might think, if you, again, looking in isolation, you're thinking, well, I've got a bias to the downside on this pair. I think fundamentally it's a sell. I'm maybe not so sure on the timing. So what I'd be looking at is from some technical confirmation. So you might wait for price to go down to this trend and break out. Now, a break and close means this, Shauna. This is the key bit. This is the daily chart. So in order for a break and close, you would want to see a bearish candlestick go through this trend line and then close outside of it. And closing outside of it means that the body of the candle closes outside the pattern. So if the wick of the candlestick went through and then bounced back, that wouldn't be a break and a close. That would be a break, but a close back inside the pattern. So one way of confirming a pattern like this would be a break and a close below. Now, the candle only closes at the end of the day. So at the end of the day, if you saw the pattern close below this level, you know, okay, well, that's a confirmation of this. I've got a fundamental bias and I've got a technical confirmation. The fundamentals and the technicals have all come together, and this gives me a bias to the downside. And I'll show. Let me show you. There is an example of this. Okay. So that we looked at this a few weeks back. We looked at a nice example of this on the gold chart. Okay. It was just here. That's it. We had a bias to buy gold. Okay, here, so we had 1, 2, 3, 4. That's valid 5. So We now have a valid move, and you see this candle, Shauna, has broken outside of the pattern, okay? Broken outside of the pattern, and then we had a couple of days move higher, okay? So that's a break and a close. You get a break and a close above. Now you can look at, potentially entering a retest. So one way traders might trade this pattern is they wait for a retest of this level, or they just move higher. So that's one. Sean, I hope that helps give a bit of help there. Hi, Tudor. Yeah, very early in the Monday session, there were rumours that Australia, Victoria State would be shut down, and the Australian didn't react at all, I remember, and today it reacted. Now the market has been very good at ignoring bad news and still pushing to the upside. Now, was this risk-off move in the market sparked because the lockdown was actually confirmed and it kind of brought the market back to reality? Yeah, Tudor, the thing that's going to really impact the market is going to be the actual shutdowns coming back in. So yeah, it's definitely going to be the actual shutdowns. And also the thing to be aware of is hang on, so I lost my train of thought there, Tudor, hang on. Yeah, so the thing to be aware of is that the Chinese stock markets, there was talk as well that had moved too quickly, too fast. I think it's those two things coming together, a little bit of a back down to reality moment. Yeah, I think that's the correct way of looking at that for sure. Yeah, and that's I've got my train of thought back. That's the thing to look at. It's not just rising COVID-19 cases that's the concern. It's to do with the shutdowns. So when we see things being locked down, and obviously Victoria being the second most populous state, we've got a huge metropolis area like Melbourne, going down for 6 weeks. That's going to be impacting the market. Hi, Shauna. Oh, thank you. Going into the US session, in your view, could we still continue to see a strong pound, especially pound yen, pound Australia, or are we likely to see a reversal? Yeah, my hunch is for a reversal, JP, because my concern here, JP, is that this bias towards positivity creeps back in. The pound, we might see more pound strength on that Rishi Sunak expectations, but I'm neutral on the pound because I can't quite see the clear way ahead for the pound. It's not clear, and particularly, as I said earlier, the way the pound has reacted strangely to a positive Bank of England, positive retail sales, positive PMI data. There is a clear bias to sell the pound. Hedge funds are, ramping up their short pound bets again. So there's a lot of, tensions going on in the pound and concerns about rising debt levels for the UK. So I really want to see how the market reacts to the mini budget that's coming out from the UK's finance minister tomorrow. That's going to be really interesting to see. Yeah, I would expect some kind of little reversal going into the US session. Hi, Drew. Just wondering if US jobs openings coming out today have a significant impact on the market. Let's have a look. No, I haven't covered that yet, Drew. So that's yeah. I think there is always the potential for jobs to impact the US. There's not some major expected shocks coming from the jobs opening market today. So that's not a big economic calendar event. Obviously, if we do get a surprise data point that raises concerns about, lack of job opportunities in the US, rising US unemployment, then that will impact the US altogether. So worth just be aware of, but not expecting any major moves from job openings today. Yeah, hi, Rolanda. As things stand right now, is there a real chance of having another drop like in March? I see the treatment medications and the hopes of vaccine and keeping a strong floor for equities. Don't you think it's time to pay attention again to economic data more than rising infections? I think that going into lockdowns again will not be enough to have massive drop like before. Thanks. Yeah, Rolando, I think what I'm looking at is the earnings situation. So it's all very well for fiscal stimulus and governments to keep companies afloat and keep them working, but if the demand isn't there, then how do you sustain a company that just doesn't have enough demand for its services or its products? So that's what I'm looking at with fascination. And in short, Rolando, I'm unclear. I have been surprised by this huge rise in the S&P 500 and global stocks. You can see here this huge retrace. I wasn't expecting such a large retracement in global stocks generally. And yes, I think you're right. I think the base case is that a vaccine is due by the end of this year, start of next year. So I think that part of this, the analysis, Rolando, I'm 100% fine with that. And then it's just, obviously rising infections in terms of if they bring lockdowns is going to result, well, it's hard, isn't it? Because will that result in more stimulus? So if it's more stimulus, then we'll see more support for equity markets. The economic data is what's going to be important for me, particularly the second quarter earnings and any projections for the third quarter earnings. So that's really what I'm focusing on coming into the end of this month and the first week of August. We'll get 50% of second quarter earnings will be released at those points. So heading into the end of July and start of August, and any early earnings reports will obviously be influential in setting the mood. So that's where I'm at in analysing where things are. Is the market generally risk on until it has a reason to be risk off, or vice versa? Yeah, I mean, sometimes, sure. At the moment, Shauna, what we're seeing sort of quite choppy action as the market is risk off and then risk on again, risk off, risk on, risk off, risk on, and it's chopping around. So it's very choppy price action. Usually what tends to happen is you tend to have more risk on or risk off themes that tend to last a little bit longer. So the specific difficulty at the moment is this chopping around of risk on, risk off sentiment. Like yesterday was like a strong risk on market, and now we're back to moving towards a risk off market. You can just see here, you've got prices moving up and then down. So we had that Aussie US dollar upside bias yesterday, didn't we? And we were looking at 6996 as our ultimate target, which, depending on your broker, would just about clipped it. But the difficulty at the moment is the risk on, risk off trading is quite close together. Yeah, Sean, do you use the triangle pattern only on the daily chart, or do you use it on other time frames? Yeah, no, that's fine, Sean. I like to use it on the higher time frames, but you can use it on any time frame. Yeah, that's absolutely fine. Yeah. Hi, Sander. The ADR we use here is average daily range, and it is a custom script that you can find here on TradingView website. Yeah. Okay, guys. Well, that's what we have for today's session. We were going up on the Aussie US dollar yesterday, and now we're heading down today. So we've come full circle. We'll be back again tomorrow, same time, same place. So I hope to see you guys there. And thank you very much for the questions. And thank you very much for the input as per always. Take care now, everybody. Goodbye.